Hi everybody. The purpose of this video is going to be to explain the significance of high volume at the top of a chart after a big run. We're going to focus on three tickers to highlight for this video. DROP, D-R-O-P, the company is Fuse Science. HPCS, which is HPC Position Systems Corporation, and of course AMWI, Amwest Imaging Incorporated. First we'll focus with DROP, and what we're going to do is we're going to look at the daily charts first, and then we're going to break it down into the intraday charts to dig deeper and really see what we're talking about here. So first things first, you need to keep it simple and remember what volume represents. Volume represents money, money represents people, and the more volume means the more money, which in theory means the more people who are playing the stock. Now, why do people buy a stock? Because they think it's going to go up. Nobody buys a stock so they can lose money. They buy a stock so they can make money. So here we have DROP, and as you can see, the main thing that you need to pick up on is for a stock to continue rising to higher prices, it needs to trade higher volume than the previous day's rise, or else the rise will not be that significant. Because for the more money that comes in means the more people that are coming in, which means the next day you need even more new money and new people to come in to force the price higher. So you can see this started here on DROP on December 2nd. You had a little under 1 million shares trade. And then look the next day. You get 3 million shares trade, and the price sure enough advanced a solid 5 cents. And then the volume trailed off a little bit, but the price was able to maintain. And then boom, on December 9th, you get a huge volume spike. And the price reacts very well, climbing about 50%, 45% or so, from 50 cents up to 75 cents. Now look what happens the next day. Volume is good, but it's not nearly as high. It's short by about 2 million shares compared to the day before. Therefore, what did the price do? It wasn't able to advance that much at all, about 10% or so. So what that meant is if you take away this day, if you just look at the chart up until, excuse me, that's not what I wanted to do. If you just look at the chart up until this day, you can see we have the volume here, and then the next day, here's our volume right here. So the next day, what do we need? We need volume in excess of 8 million shares, I would say, to be able to climb higher and press towards $1. What happens? Look at that. Great volume spike. And the price really reacted well. Hit a high of $1.25, which is really nice. And that was all possible because you had a huge volume spike. You had tons of new money and new traders coming into the stock. But here's what the real takeaway needs to be. Look at this wick here. So the stock was able to trade up to $1.25, but it wasn't able to hold on to those gains. It actually closed at 98 cents, meaning it was 20% off the highs, 20 to 25% off the $1.25 high of the day. Now remember, look at all this volume that traded up here. That's new money and new people, which means a lot of new money came in above $1 and at between $1 and $1.25. So what does that mean? That means all those people who bought above $1, they're down. And anybody who bought above $1.20, they're down 20%. They're down a lot. So once again, let's pretend like this day isn't here yet. So here we have our great volume spike, closed at 98 cents. What do we need to have happen the next day in order to get back up to $1.20? We need volume in excess or at least near 12 million shares to be able to get through the new supply that got created and the new money that's between $1 and $1.20. Because remember, there's a lot of people that are stuck. And the only way to get through all those people who are stuck is with new money. So let's see what happens here. Sure enough, volume is quite low today. And the high is $1.05. Now that's interesting because the volume wasn't high enough. And what do you have going on around $1.05? You've got people who are stuck between $1 and $1.20 cutting losses. You've got people who got in between these levels and didn't take profits up around $1.20, taking their profits because they saw the big retracement. And you have lesser volume because everybody knows now you're going to need a ton of volume to get through here. So it becomes kind of self-fulfilling because, hey, I don't want to buy that stock. It needs a ton of volume to get higher. And then that's what person A is saying. Person B, he's saying, yeah, you know, I don't really want to buy it either because it doesn't look like it can get up to 120 without 10 million shares or so trading. So what happens? All these people have the same mentality, so therefore the volume doesn't come in. And this is best exemplified by looking at a 30-minute chart. You can see yesterday the huge volume that came in here to bring it up to $1.20, but then look at that huge volume that came out. You see that? So now we need volume to keep up like that. And it was good for the first half hour of the day. It was good, but look what happened here. Big drop off, even bigger drop off, and look what's happening now. It's starting to decline because the volume isn't keeping up and people are realizing, hey, it's probably not getting to $1.20. The next most likely case is probably 80 cents rather than $1.20. So if you've got profits, you want to protect them. And if you're on the sidelines, you're not buying here. There's no reason to buy here. So the momentum is stalling. So it's very important to understand when you have high volume trade in a particular range, you need even more volume to trade, okay? So that was drop. Now let's look. We have the same thing. You can see this time and time again. HPCS. Look at this high volume here when things got started. Real high volume, traded all the way up to 14 cents, okay? But we have a similar situation to drop. After going from 11 cents up to nearly 15 cents, a nice 35-40% rise in a day, it closed at break even at 11 cents. So now everybody who bought between 12 and 14 and a half cents, they're down. And they're scratching their head wondering if they just made a really bad decision to buy. So what needs to happen for them to come out of their positions ahead? Even more volume then needs to trade to be able to break to new highs. Because these people, they were demand at first, but now they're going to become supply. New money came in, new people. Now we need even more new money and even more new people to break to new highs. And what happens the next day? A huge volume drop off of about 2.5 million shares or so. So no duh, the price sank because there wasn't nearly enough demand. So you have these high volume tops, and you can see it again on the 30-minute chart here. You see high volume, you know, brought it up to 12. But look at this up here. Low volume trading up here between 13 and 14 cents. Not a lot of demand. Good high volume between 12 or so, but then look, we fall out of this little range that we had developed on high volume. Now people are wondering what's going on. You know, excess supply now. And now look, we're going to need more volume than all these previous days. If you look at this, if you go like this, here we go. Look at these volume spikes. Up around 2 million, 1.5 million, 1.2 million. We're going to need that type of volume to keep up, to be able to move to higher prices. Let's see what happens though. Uh-oh. Look. Hardly any spikes near, as a matter of fact, not one spike above 1.2 million shares. They're a lot closer to 400,000 or so. Remember, this is a 30-minute chart. So each candle and volume bar represents 30 minutes of action. So what happened? The price decreased all the way from 14 cents. Now it's down 50% to 7 cents. It's because you don't have a lot of volume trading at the top that you need to be able to push it to higher prices. Lastly, AMWI. Now this one is very unique in that it did a complete about face in the middle of the day. But you can still examine the volume and still learn something from it. So here we had a nice run. Notice the volume got higher here on the breakout day, and it was very good, similar to drop those two back-to-back days on the 9th and the 12th. AMWI had the same type of thing on the 6th and the 7th. The price was able to react very well because although this volume wasn't higher than the day before, it was good enough. It was within, striking distance. But if you look here, we're going to break it down into a 15-minute chart to really catch the drop. Now, look, high volume here, high volume here, high volume here. The volume is getting higher and higher consistently. So that's great. It's able to rise because enough new money and new people are buying in, causing the stock to continue to rise because there is enough new demand. But look what happens here. Here's your first sign. If we just, it's not what I wanted to do. Here we go. Here we go. Look at this spike. This is the first trouble sign right here. A giant spike of 2.1 million shares. That was one of the highest spikes that day and one of the highest spikes over the last 2 days, coming at the top of the chart. That's the key. It's not like this spike. There's a high volume spike too on a decline, but that's in the middle of the chart. It doesn't have the same implications as at the top of the chart. Because remember, not a ton of people have profits here, and not a ton of people have losses here. But up here, you have a ton of people with profits from 40 cents to $1.20. We've got a ton of people up 200%. And look, we've got people, look at all these people buying over 120. We've got all these people, once we broke below 120, all of a sudden, right now, they're down. They now need to rethink. Did they just buy at the top? So now, what do you need to happen? You need to have greater volume come to the upside to wash these people out and climb up back towards 140 where the price had just fallen from. Let's see what happened. Boom. Huge drop. Look at this spike right here. That is a gigantic spike. And, this just goes to show you have to be alert because the trend can change like that. And once the volume starts coming out on a stock like this that's up so much for so many people, all these people down here all have tons of gains that they're going to be locking in because look how quickly it's dropping. People will start panicking. And to make matters worse, all these people who bought between 80 cents and $1.40, look at this drop that happens from 120 down to 60 cents in a period of 15 minutes. You're talking about people being down 50% and more in a period of 15 minutes. So you better believe this is going to have a hard time recovering, and you're going to need a ton of volume to soak up all the losses that these people are going to be taking, in addition to all the profits that the people who bought in low are going to be taking. And what do you get? You don't get that. You get volume relatively equal to that spike. About 9 million shares on that spike traded from 120 down to 60, and then the next day you got 9 million shares. Remember, we're looking at a 15-minute chart, so in this case, every candle and volume bar represents 15 minutes of price action. So, the writing was on the wall that this was not going to end pretty. And you get a little bounce here from 30 up to 50 or so, but what's going on, you've got a couple things at play here. First, all the people who bought in low, around 20 cents where it was for 2 weeks, they're selling. They're still up 100%. They say, hey, that's good enough for me. I was the idiot that wasn't selling at 120, but I'm happy to sell at 50 now that I see it's done, And in addition to that, you've got all the people, look at this nasty wick. All the people who bought above 60, they're saying, man, I'll take a 20% loss here before it becomes a 50% loss, or I'll take a 50% loss before it becomes a 75% loss, because there's just not enough volume to be able to get it to bounce up to the levels I needed to bounce to break even. And once again, it becomes self-fulfilling. All these people with the same mentality, thinking the same thing, do the same thing, which triggers other people to then do the same thing. So what do you have? No surprise, a lower volume bounce, and then boom, a huge sell-off, and now here we are back down at 20 cents on nasty volume, and it's just not pretty. But if you're able to analyze the volume at the top, you never have to worry about this, because you can see that the volume is sending you a signal, and you need to react to that signal quickly, because things can change in a heartbeat. And if you're not prepared to react to the slightest change in volume pattern, you will get chopped up and you will lose money, or you will leave major profits on the table, which I guarantee you a ton of people did on AMWI. So hopefully now everybody has a better understanding of how to interpret volume at the top of a chart after a big run, and how to react to that volume in a way that best prepares you to profit.